Let's talk hard money. Hey guys, I'm Zach Sykes at Untitled Co. And we get asked all the time from our agents and customers and clients and investors, and what type of money should I use? First you think, hey, everybody's green, right? Use the green kind. But no, that's a bad joke. Okay, my dad joke.
No, pennies aren't.
What?
A lot of investors, whether they're just starting out, hear the term hard money a lot. And today I want to talk about the difference between hard money loans, traditional, conventional, long-term 30-year fixed loan financing, and the options that are somewhere in the middle. So a hard money lender is typically a lender that lends money on a hard asset. And that's where the term hard comes from. It's an asset-based loan, meaning if I've got a good enough deal on this house, let's say it's worth $100,000, I bought it for $50,000, they may loan you $65,000 to purchase the property and do some towards the renovations. So that way, if you don't make your payment, they're gonna take the property back from you and resell it and still be right side up and make some money. So either way, the lender wins. And if you do your job right, you can win too, but the risk falls back on the borrower using that hard money. The pros of the hard money is that it can be a little easier to get a loan sometimes if the deal is good enough. Some of the cons using hard money is they typically have really high rates and really high fees. They're expensive to use. They're also usually a very short-term lender, typically no more than 6 months or a year. And so you've got to turn that property around really fast and get it refinanced or sold in order to exit that hard money agreement. It's a little more dangerous, a little more risky, and it's not something we recommend for the beginning starter investor. Now, the traditional lending is what a lot of us are really used to, right? It's those 20% down loans or putting 20% down on a property and holding it for a 30-year fixed rate, right? Those traditionally really low rates and really great terms type of loans. Those are probably the lowest risk of the type of money or type of financing you can use. However, they typically require a lot more cash. They require a very strict debt to income guidelines and credit stuff, so much harder to obtain, and quite frankly, they may not always be the best use of your cash. If you're doing an investment property, let's say that same one, you bought it for $50,000, the bank's gonna want their 20% down of that $50,000, and then you are going to pay in cash out of your pocket for any upgrades or repairs. Even if the appraisal comes in and says it's worth $100,000 and you got it for $50,000, the bank's only gonna loan you that 80% of the purchase price on that property. Any repairs or upgrades you're gonna do to the property are gonna have to be paid out of your pocket. That's the downside of the traditional financing. The upside of the traditional financing, great rates, great terms, great fees, and you're gonna hold it for 30 years. The downside, it's really tough on your cash positions. Now I want to talk a little bit about the place in the middle. So for those of us that have been in real estate for a long time, maybe being a realtor, helping people buy or sell property, we've been using those traditional 30-year fixed, 15-year fixed, 20% down loans for investment properties or second homes. So we always think we have to have certain things to qualify for those types of properties, and it's always 80% of the loan amount or the appraisal, whichever is lower. Well guys, if you have good relationships with a local bank or regional bank or great local bank in your market, there's the old school way of doing banking that's also available. This is what we refer to as more of the common sense banking, right? Let's think about it like this. Let's say you buy that same house for $50,000 and after it's fixed up, it's gonna be worth $100,000. That good local bank may say, you know what? I'm gonna loan you 75% of the repaired value. So we're gonna give you a loan amount of $75,000 to go do that property. Now their rates and fees are typically gonna be less than the hard money and higher than your traditional 30-year fix, or somewhere kind of in the middle. But a lot of times you can get in for a little bit less cash up front once you have a relationship established and a track record. Now, your first home or two or three with that lender, they may still ask you to put a 20% down up front in order to show you know what you're doing, the bank can take a risk on you. If you want to borrow more money and have good relationships with the banks, then you need to be a low risk to them. What helps us be low risk? We need to have good income. This is why it's really hard for just a solo investor without another job to make a living at this, because it's really expensive to get financing. If you've got a regular income or other sources of income, it makes you much lower risk to the bank. So even if the property doesn't sell, you can still pay for it, you're a low risk. What else makes you a low risk? A solid track record. How many properties do we have? How many properties have we rehabbed? How many investments have we gone through? The easier it is to show the bank that, hey guys, I'm a low risk. Give me better rates and terms. The next piece I want to talk about, guys, is the relationship. This goes back to the risk and building trust. A lot of times in the old school, traditional common sense lending, they have what they call a loan committee. That's where your loan officer, your contact at the bank is gonna take your loan in front of the committee and say, you know, I recommend we do this loan, I recommend we don't. And the other people in the committee, we're gonna try to poke holes and say, hey, is this person risky or not risky? Is this person a good bet or a bad bet? And if they're a bad bet, then are we gonna either raise the cost so it makes it worth our time to take the bet, or should we say no deal at all? So you have to give your loan officer, you have to give your banker ammo to show the other people on that loan committee that you are low risk and you are a safe bet for the bank. You're absolutely gonna pay them back, and with interest, guys, because they wanna make money too. So what do we recommend? Guys, there's three main options. You can go the hard money route, expensive, easier to get, that may be your only option if you're a young investor, don't have many deals yet, much cash on hand. You can go the traditional 30-year fixed stuff, 20% down for investment properties, or you can do the traditional bank financing, the old school common sense lending you can do with your local bank. If you need referrals for any of those three types of lenders, let us know. Happy to help you. Hey guys, I'm Zach Sykes at Homestead & Co. And thanks for watching.